Hello, from LPL Financial. Welcome to The Talking Point. I'm your host, Quincy Krosby. Good morning, everyone. This is Quincy Krosby. It is The Talking Point. It's Monday morning, October 7th. It's going to be a busy week for the market. Just a couple of things I want to go over from last week, and that is, oh my goodness, the surprise with the payroll report. That surprise to the upside every way that you can look at it. Let me go over it. The headline, remember the expectations were about 145,000 new jobs created. Whoa, way above that. In addition to that, we had a revision from the month before, and that was an upward revision. Keep in mind that we have been having downward revisions, and finally we had an upward revision. That's good news. The market pays very close attention to those revisions, and when they are consistently downward, yes, it begins to point to a major slowdown in the labor market. And instead, again, I want to repeat, we had an upward revision for the month before. Also, and probably even more important, was that the unemployment rate not only did not stay the same, which was what was the estimates, the consensus estimates, that it would remain at 4.2%. It went down to 4.1. That is good news for the market. And you can see the market's reaction. What it suggests is that the economy remains resilient. The economy remains solid. And this is important because there has been a bit of a tug of war in the market with those saying, well, you know, we see a recession coming, including those who said, by the way, we're already in a recession. It'll start to unfold and everyone will be aware of it. And when it comes to consumer spending, obviously the link with the labor market is incredibly strong. The consumer spending, 68% of our economy, is not going to hold up if folks believe that the labor market is weakening at a faster pace. People start pulling back, slowing down their spending. So in any case, it was very good news for the market. As we go into this week, I want to point out a couple of things. One is all eyes on the Middle East. Why? For a variety of reasons, obviously. Geopolitical risk, and obviously it is climbing higher. But when we look at the market, one of the things the market is focused on is where does the price of oil go? Here we are in a scenario in which when you look at the Gaza and Israel, there's no oil there. So when that began a year ago, the market wasn't worried about it only because there's no oil there. It isn't an oil producing area. As this conflict goes deeper and deeper towards Iran, into Iran, the question is Israel thinking about hitting their energy complex, their energy infrastructure? We don't know yet, and we will soon find out. But the point is that the question becomes, then what happens to the price of oil? And this is all we're talking about in terms of the market, not in terms of casualties, but just in terms of the market. Right now, oil, West Texas Intermediate Oil, WTI, that's the American benchmark, is still below $80 a barrel. And this is a very big if their oil fields are attacked, we could see oil surging higher than that. And it will be reflected in gasoline prices here in the U.S. Now, on the other side of that equation is the Saudis have strategic oil, right? They've got oil in the complex, which they can release and then help ease the price of oil. They can do that easily. And the question then becomes, how much oil would we need? Also, in the United States, there is a strategic petroleum reserve, as everyone knows, and oil can be released from there. However, when oil was released at the start of the Russian-Ukraine conflict, you remember that the administration released oil from the strategic petroleum reserves. And the question is how much oil is actually there now, because we've been watching to see how much replenishment there's been. So the question then would be for the market is how high does the price of gasoline go? And as we enter the heating season, particularly in the Northeast where they use oil, how much is that going to cost? So we're not there yet. I just want to point this out as we get answer perhaps of what is going to happen in terms of the conflict spreading deeper into that region. Also this week, and very important, is what are we going to see in terms of inflation? This week is the Consumer Price Index and the Producer Price Index. That's the PPI. The reason I'm mentioning this is now the Fed, which was very much focused on the labor market and their mandate from Congress, the maximum employment mandate, they could take a sigh of relief that, my goodness, look at the labor market. It actually looks as if it is stronger than we thought. Keep in mind Chairman Powell's comments. He said we cannot allow, in essence, the labor market to soften anymore. They wanted to make sure that they are focused on the labor market, the maximum employment mandate. And he made it clear, we will go in and lower rates. Remember that 50 basis point rate cut. Yes, it had to do with inflation coming down. Absolutely. But it also had to do with their concerns over the labor market. Now that the labor market looks as if it is in good shape. Now, remember, it's just one report, and the Fed is going to need more reports than just that one. But nonetheless, there is an issue and a question about inflation. Is inflation ticking higher? That's going to be important for the Federal Reserve, obviously, because that's their mandate. Now, the criticism is coming in about that 50 basis point rate cut. We are going to have a parade of Fed speakers this week, and they will have their say about how they view the labor market, how they view inflation, and whether or not they believe inflation is, in fact, ticking higher. We had the ISM, Institute for Supply Management, Purchasing Manager reports, PMI. When it came to the manufacturing part, actually the prices paid came down, which was good news for the market and very good news when we look at how prices are moving. However, the service sector, the largest portion of our economy, actually showed prices paid higher. So right now, the Fed is undoubtedly trying to ascertain whether or not we're seeing an uptick in inflation. So all of this feeds into what we can expect for the November meeting for the Fed. This will come right after the election, and whether or not they go with 50 basis points or 25. Most likely, it will be 25 basis points, or if inflation is climbing higher, there are those who believe we may not even get a cut in the November meeting. So all of this is extremely important as we piece together a mosaic on the economy, on inflation, and again, the labor market. Now, another thing very important for this week, at the end of the week, we will have earnings. It will be kind of the unofficial, I put that in quotation marks, opening of the earnings season. Remember, in earnings, we look back. So we're looking at the third quarter earnings season. We are going to start with the banks, as we always do. And this is going to be extremely important for us because here we will hear about, are they raising the amount of money that they have in reserves because they're worried about losses, people not paying back, companies not paying back. All of that is going to be important. In addition, some of these big banks have credit cards associated with them. We'll hear about how are folks paying back those bills, and are they using their credit cards, or are they slowing down their spending? Also, we will hear about the broader view that they have of the economy, the U.S. economy. This is going to be extremely important as we listen to what the big banks have to say. And then going into next week, we will start to hear from more of the regional banks. And again, we piece together what they have to say about the strength of the economy. This week also we'll have another view of the small business owners and how they view the economy. Are they worried about higher prices that they have to pay? Are they worried about sales coming down and maybe spending not strong enough for them to just say, I'm more optimistic than I was last month? Remember, this is an optimism index, and we want to see whether or not they feel a little bit better about the economy. Remember, small businesses in our country, they are the backbone of the United States of America. They create 55% of all new jobs. So what they have to say is very important. So we'll be looking for that. And last but not least, the minutes will be coming out from the last Federal Reserve meeting, which obviously was important because they came in with 50 basis point cut. So what we're going to look to see, what were they saying? What were they thinking? We know that there was one person, and that is Michelle Baumann. She is a member of the Federal Reserve Board, that she said, well, I want to go with 25 basis points, not 50. You know, perhaps Michelle Baumann actually said something deeper in that meeting, and we may be able to pick that up in the minutes. So a lot for the market to digest this week, but also for a market that is very pleased with the fact that the payroll report was stronger than expectations. The unemployment rate came down, and all of that is important for us to assess the strength of our economy. Right now, as far as the market is concerned, we're going to be, again, I want to repeat this, watching to see where the 10-year Treasury yield goes. It's already above threes. It's now just above 4% on the 10-year. Again, factoring in the strength of the economy and factoring in a concern that perhaps inflation is inching higher, even at the margin, to slightly inching higher, and crude oil prices also moving. We will watch the oil prices because the oil prices will reflect what is going on in the Middle East and what they expect going on in the Middle East. Have a good week. We will be back next week. Thank you all so very much. Take good care. This material was prepared by LPL Financial. It's for general information only and is not intended to provide specific advice or recommendations for any individual. There is no assurance that the views or strategies discussed are suitable for all investors or will yield positive outcomes. Investing involves risks, including possible loss of principal. Any economic forecast set forth in the podcast may not develop as predicted and are subject to change. References to markets, asset classes, and sectors are generally regarding the corresponding market index. All indexes are unmanaged and cannot be invested into directly. Index performance is not indicative of the performance of any investment and do not reflect fees, expenses, or sales charges. All performance reference is historical and is no guarantee of future results. All information referenced in the podcast is believed to be from reliable sources. However, we make no representation as to its completeness or accuracy. Securities and advisory services offered through LPL Financial, a registered investment advisor and broker-dealer, member FINRA and SIPC. Insurance products are offered through LPL or its licensed affiliates. To the extent you are receiving investment advice from a separately registered independent investment advisor that is not an LPL affiliate, please note LPL makes no representation with respect to such entity. If your financial professional is located at a bank or credit union, please note that the bank or credit union is not registered as a broker-dealer or investment advisor. Registered representatives of LPL may also be employees of the bank or credit union. These products and services are being offered through LPL or its affiliates, which are separate entities from and not affiliates of the bank or credit union. Securities and insurance offered through LPL or its affiliates are not insured by the FDIC or NCUA or any other government agency, not bank or credit union guaranteed, not bank or credit union deposits or obligations, and may lose value.